entrepreneurs, Joe DiChiara, CPA slash entrepreneur, your host of How to Win Big at Business. This is episode number two of many, many to come. And this podcast is really all about the entrepreneurial journey from, the minute you have an idea for starting a business all the way to exiting the business and everything in between, all the bumps, all the potholes, and all the successes. And really what I'd like to focus on is not just the pain. It's painful running a business. When you start a business, it could be like, and in the last episode I talked about the delusional entrepreneur. And if you're a real entrepreneur, you're delusional. I'm sorry. Uh, I'm delusional. And what I mean by that is we do things that defy logic. I mean, look at Thomas Edison. The guy failed reportedly 10,000 times trying to create the light bulb. And his response was, I didn't fail 10,000 times. I found 10,000 ways that it didn't work. And Thomas Edison was a real entrepreneur, and Benjamin Franklin was a real entrepreneur. And let me define what I mean by real entrepreneur, because there are people in business that aren't really entrepreneurs. And I'm not trying to take anything away from them, but those are people that say, you know what? I want to make money. I want to quit my 9 to 5, or, I have to make money because I just lost my job, or I need more income. So I'm going to, become an Uber driver. Believe it or not, an Uber driver is a business. And I call them accidental business owners. They don't realize, a lot of them don't realize that they're actually in business. But a real entrepreneur like me goes through their day or wakes up and thinks of something that they can fix if it's broken, or something that they see that they think they can make better, or some kind of new gizmo or contraption. And they say, you know what, I'm going to do that and I'll figure out how to make money later. So we have these ideas, and if you're an entrepreneur like me, you have ideas all the time. Most of them are bad ideas. And the proof is in the amount of people that actually fail in business. So I thought I would kick off this episode and talk about what happens to the real entrepreneur when they actually launch a business. The first episode, I spent a lot of time talking about me and what I plan on doing with the show. So now we're going to start getting into the real meat and potatoes. And let me start by answering a question that nobody has actually ever asked me. And the question is, when does the business actually start? And it's important. And I'm going to tell you why it's important. It's extremely important. There's only two things that you need to start a business. Number one is a profit motive. If you have an idea and you say, I think I can make money with this, and I want to make money with it, you're supposed to make money when you go into a business. That's why they call it a for-profit business. A lot of people have ideas to do good work and start a not-for-profit business. Well, obviously, what the term means is you're not doing it for profit. So that's not a business. The second thing that needs to happen is action. So only two things. So it's really easy to start a business. You need an idea, and then you have to take action. Now, what that action is could be just about anything. It could be, hey, I'm going to start a business and I need a computer. So you hop in your car, you drive down the Staples, and you buy a computer. Well, right away, here's why it's important. The computer's a write-off. People, I think understand that. And once you start using your car for business, that's a write-off. And now where are you going to work? You're going to work in your home. So part of your home is going to be a business write-off. Now, a lot of people are under the impression that they can start writing stuff off when they start making money. In other words, in their mind, they're not actually a business. But let me tell you something, the people that care, namely the government, and it's not just the Internal Revenue Service, although that's the first thing that comes to mind. Really, it starts at the local level. So it's the state, the county, the town. They all have a vested interest if you're doing business. Think about it. Think about it. A lot of businesses require a license, a permit. Uh, they want you to be registered. And why do they want you to be registered? So they can start collecting fees. Now, the IRS really doesn't care if you never register the business and you never make a profit. That's not their jurisdiction. The state and local government care. They care a lot more. Okay. And I'll get into that in another episode when we cover things like Nexus and incorporating your business, making it a formal entity. But so you've started a business. So the reason why I say it's extremely important, not so much for the compliance issue, because you have tax write-offs now. And if you don't understand this, those tax write-offs will disappear forever. Now, how you get those tax write-offs is another story, okay? And that depends on how you structure your business, what your current tax situation is. And I actually have a whole chart detailing what steps that you should take. So in other words, there's the situation where, let's say you have a job and you have taxable income, or you're retired and you already have taxable income. Well, in that case, what I recommend is you set up an S corp and you report all the expenses, because now you could write that stuff off on your taxable income. So you're going to reduce your taxable income by whatever your deductible business expenses are. So also I used a couple of examples that might seem obvious: a computer, a the car, your home, then you have your telephone, your internet connection. Now, these are all things that you already have. You're already paying for this stuff. But what you've done now is you've converted it to business property. So whatever the portion of your home that you're using for business becomes a tax write-off. So things that you couldn't write off before actually become a tax benefit. Isn't that cool? So a portion of your electricity, a portion of your real estate taxes, if you're paying rent, then a portion of your rent. And it's all going to be determined by the square footage of the business portion of your property. The next thing that happens that gets people into trouble. So the first thing is to recognize when you actually started the business. The next thing that happens, so how did you pay for that computer? How did you pay for, the gas to go to Staples and buy the computer? Well, you don't have a formal business set up. So you're going to pay this stuff out of your personal funds, either your personal checking account, you're going to use a credit card. Either way, what you're doing by default is you're commingling business and personal. Big mistake, big mistake. And I'm going to cover, books and records at some point. That might bore you to death, but the truth is the IRS, not just the IRS, but state and local governments audit people. And the audits are going to be coming fast and hard because the government's using technology. Right now it's 2025. So if you're listening to this podcast right now, you probably know that the IRS is broken. They can barely even answer the phone. So there's not a lot of audits going on. But at some point, believe me, they're going to be going after people. And they're using technology and AI, and the way that they're doing audits now is kind of scary. They don't book an appointment and meet with you to go through your records anymore, which is what they always did. Now what they do is they just ask you to fax in all of your receipts. And then what they're going to do is compare your receipts to what you've deducted on your tax return. It's all machine driven. So there's no human interference, there's no human cost. Yes, somebody hopefully is going to review this, uh, but I could see the machines actually taking over and saying, oh no, these your repairs and maintenance don't add up to your receipts, and they can actually automatically generate a tax bill without anybody ever even reviewing it. But that's, in the future. I like to, predict the future. Sometimes I'm right, sometimes I'm wrong, but only time will tell. But so now you know you're in business, the mindset that you need is to separate as best you can your business expenses from your personal. So the items that I just mentioned, like your home, your utilities, those are primarily personal. And that's how you got to keep them. You don't pay them out of your business account once you have one set up. You're still gonna pay it out of your personal funds. Now we have a method, we call it the accountability. And all it is a spreadsheet where you're gonna, fill in the blanks, utilities, rent, anything, and any other out-of-pocket expenses that you have that are business related. You're going to calculate what it is, and then you're actually going to write a check out of the business back to you, reimbursing yourself. And that's how an accountant gets all those unaccounted for expenses onto your tax return. So there's a method to doing it. Now, I've never run into somebody that said, "Oh yeah, I started a business and I opened up a checking account just for the business expenses, and I'm only using this one credit card for my business." That would be easy. That would be easy. Now, I'm talking about the period before you actually formally set up a business, because once you incorporate, you set up an LLC, you set up a DBA, and you get a tax ID number, you pretty much, you have to, not have to, because people don't do this. You should, and I say should with an emphasis, open up a separate business account. Now, with the credit card, you don't need to have a business credit card per se. You can have any card with your name on it, but what I advise my clients is just use those cards for business. So myself personally, I think I have 10 or 12 credit cards. I'm a typical American consumer. I have a lot of credit cards. So I have three cards that I use just for business. I have two Amex cards and a Capital One card. I use primarily one Amex card for travel and the other two for just purchases, recurring charges, and stuff like that. All the other cards I either pretty much don't use, thank God, because I don't need them, or I'm using them for things like clothing, food, things that are personal. So I'm separating my business and personal. But normally that doesn't happen. So when we get a client, the first thing we do is we want to determine, when did you actually start this business? And we have to go back in time. Now, sometimes they could have started the business years before, 2 or 3 years before. That's normally the time frame. So then what we got to do is we got to trace back, we got to get their statements, and we have to account for everything. That's why they call us accountant. We set up an accounting method, and that could be, normally what we do is go through your statements, highlight what was for business. We're going to put it on a spreadsheet. We're going to categorize everything, and that becomes your, part of your books and records. It should be, every expense needs to be backed up with a receipt. Again, most people aren't, what do you call, organized enough to save the receipts, or they make the mistake of thinking, oh, the receipt was emailed to me. Now today we get receipts all different ways. They're emailed, they're stuck in the cloud somewhere. People think that, oh, I paid this with PayPal, so that my receipt's there. Or a lot of people make this mistake. I paid it with my credit card, so that's my receipt. No, that's not a receipt. That's a statement. A receipt is a document that's going to show what you bought, when you bought it, who you bought it from, what it is, and how much you paid for it. So it doesn't even have to be a formal receipt that comes from a store, but it's got to be some kind of written document, preferably from the person or business that you purchased it from. Now, if you don't have a receipt, what you can do is you can create a journal. So a journal would be a written document that has all that information. So that's, if you ever get audited or if you've ever gotten audited, you know how valuable that can be. So that's the record keeping. The idea is, number one, let me determine when I actually started the business, then what actions did I take? What money did I spend? How did I spend? How did I spend it? And even if it's cash, okay, there's a rule, they call it the de minimis rule, and that means that anything under $75, you don't actually need to have a paper receipt. What you need to do is you need to document, okay? Now, if you get audited, the auditor is still going to ask you for all the receipts. So if you're handling the audit yourself, which I don't recommend anybody handles their own audit, because the IRS will trick you. And the truth is, a lot of the auditors don't even know what the laws are. They don't know about things like the de minimis rule. That's not their job. They're trained to ask for receipts. They're trained to do things in a certain way. Ask for the receipts, review them. Do they make sense? Add them up. Do they total to what's on the tax return? If they don't, they're disallowed. So there's that. The next mistake people make is, like I said, I think I said it in the first episode, is they wait too long to hire somebody like me. They wait too long to hire an accountant. Reason being, when they look at, well, I believe there's two reasons. Number one, they don't know that they need an accountant because, like I said, the idea is, oh, I'll do this when I start making money. No, no, you could be throwing away thousands, tens of thousands of dollars in tax write-offs. So they don't hire an accountant because they don't even realize maybe that they're in business. And the other reason, which is probably more prevalent, is accountants cost money. Accountants cost money. And a lot of people most people, as a matter of fact, most people wind up doing their own accounting and their own taxes. When QuickBooks came on the scene, and I was right on top of this, I started accounting when we actually had lead pencils and adding machines. Then we had computers. Then QuickBooks came on the scene, I think around 1993 or 94. So QuickBooks changed everything because they sold business owners on the lie that they could save money. I'm going to put save money by doing their own bookkeeping. The biggest lie that business owners have ever been told. You can save money by doing your own bookkeeping. Now, I made a lot of money teaching people how to use QuickBooks. I didn't realize what a big mistake it was at the time. What I did was I put an ad in a newspaper, small ad, QuickBooks setup, training, and support. My phone was ringing off the hook. I couldn't believe it. Unfortunately, half of those people that I went to see, their QuickBooks files were so mangled, I would have to tell them, listen, you can't save this QuickBooks file. There's too many things wrong with it. Some of them were shocked. They would be, but I have all my records in there. I'm like, yeah, but they did any number of things wrong. Okay. After a couple of years, I stopped doing that because I realized, I said, you know what? An auto mechanic, a restaurant owner, they should not be spending time on bookkeeping. Okay. But it was cheap. It was user friendly. It was easy. So what are you going to do if you're a business owner? I understand. They're like, oh, if I hire an accountant, they're going to charge me $300 a month. I'm going to save that money by doing this to myself. And at the end of the year, I'll go to an accountant. Or how about this? They create TurboTax, same company into it. So now you can do your own bookkeeping and your own taxes. Big mistake. Those are the people that get audited. Why? Because when you use TurboTax or a program like it, where you self-prepare it, your return isn't signed by a professional tax preparer. It's the signature says self-prepare, and it's like the red flags, the lights start blinking at the IRS, and they're like, oh, we got another one. And depending on the amount of income involved, those are the people most likely to get audited. So I shared in the first episode that there's over 33 million businesses in the United States. 30 million of them are still solopreneurs. Most of them are classified as sole proprietors because they don't hire an accountant. So that's another mistake. So, and the truth is, whatever the accountant's going to charge you, you should be saving that in taxes, or at least the comfort knowing that, hey, I went to a professional. Now, not all accountants are great. I'll grant you that. Uh, but at least you tried. Okay. You got to get professional help. I wouldn't try to pull my own teeth. I wouldn't do my own root canal. I wouldn't try to fix my own car. I did that when I was younger, and I had a car and they were easier to fix. And guess what? I blew my engine twice. So I stopped trying to fix my own car to save money. And people that go into business need to hire an accountant. I have a mentor, a business coach, world-class guy, winner of multiple awards, won Entrepreneur of the Year, owns a $200 million empire, and he's a well-known public speaker. And he goes around. One of the things he tells people is, listen, if you can't afford to hire an accountant, you shouldn't go into business. You shouldn't go into business. So I think I'm going to end this episode here. It was a lot of information. So if you are an entrepreneur, the next time you start a business, start documenting everything. Realize that everything that you do that's related to your business is a business write-off. Quick story. I had a client, a doctor client, who's started as a side business, just shared a TikTok video with me where the accountant said, oh, you could write off your Thanksgiving dinner. And she went into this whole thing. And she was right, because she said, what you can do if you have a corporation, you have to have a board of directors. So you make let's say your family, your children, your wife, members of the board. Now you got to document all of this, right? Let's say you go on a trip, so the trip becomes a business write-off, because during Thanksgiving dinner is when you're going to have your board of directors meeting. So that's really pushing the envelope. But if there was an audit and it was challenged, if there was proper documentation and the right intent, yeah, that would be a business deduction. But that's for another podcast when I cover out of the box business deductions. I'll share some of the wacky IRS audits where people took crazy deductions and they went to court and the IRS lost. So a lot of fun, interesting things to cover. That's where we're going to end it. Again, Joe DiChiara, CPA, big slat entrepreneur, the founder of Bedrock 360 Business Solutions, and the obviously the host of How to Win Big at Business. God bless. That's my story. I'm sticking with it. Over and out. Thank you.